If we start again with the simplest representation of a market on a two-dimensional space, we have the tick chart, which is time and price. And we have each bargain as it's struck creates a pattern of dots or points that is a very diffuse representation of a market. There's no shape to it, there's no sense of trend or direction or indeed pattern within it. If instead of joining the dots to make a line chart, but if instead we segment the market and take the highest trade in that segment and the lowest trade in that segment and represent that by a vertical line, and the closing trade in that segment, represent that by a dot, we immediately create a bar. And if we do that for every interval, so here's the highest, here's the lowest, and the closing trade is here. If we do that for every interval, we create a series of what are called bars, and there's the lowest trade, there's the highest trade, here's the closing trade, and that's the way we can derive, here's our highest trade. We should really be consistent as to where we put this bar. Let's put it at the end, so there's the highest trade from there. Here's the lowest trade, say there. Put the bar at the end of the price interval and the closing trade is there. We get a series of bars, or what it calls, and this is a bar chart. It can be represented in several different ways. So sometimes you include the opening trade as well as the closing trade, and sometimes you don't. There's slight variations, but broadly speaking, a bar chart is a series of verticals that result from segmenting the price action to clarify and create a shape. That, put simply, is the bar chart. And the point about bar charts, and the extremely important thing about bar charts, is to understand that the same market can look very different according to how you segment the price action. So let me be clear. Let's again start with our simple representation of a market in terms of trades, bargains struck over time, successively. That's our first incoherent representation of a market, which we need to develop from. The bar chartist divides the market into segments of time, and in each period he finds the highest trade. I'm going to be consistent by I'll be marking the bar at the end of the trade, the lowest trade and the closing trade, and he'll represent that as a bar like this. So we have one bar, we have, this is a very big range, 2 bars, the closing trade is there, 3 bars, the closing trade is there, and so it goes on, the closing trade is there. That's a simple representation, we've broken it down, but my point is not just the derivation of bars from tick charts, but also to point out that over time, if we look at the same market, the same market will look very different if those time intervals are, for example, daily, weekly or monthly in a market. And it is the different pictures that different segmentation gives rise to that is an enormously rich source of information about trends and patterns in markets.